Hi, I'm Kevin from Personal Finance Lab and Stock-Trak, and today I'm going to talk to you about what it means to get audited for taxes. To get started, an audit is when the IRS takes a look at the tax return that you submitted and decides there's something fishy. Basically, there's a couple things that will trigger an audit, and the biggest one is if you have really high income. If you have higher income, there's a better chance you're getting audited just because if you do have something weird, the government can get a lot more money from you by doing an audit. But what really triggers the most audits is if you have really complex income. So things like you have a lot of stock that you've bought and sold, or if you have really high income from several different sources, like you're earning dividends from a company you manage, plus you get a salary, and then some of it comes from offshore accounts. All those things are reasons why the IRS might take a bit closer look at your expenses and income and try to do an audit to see if you've paid everything you should have. Basically, the government's going to do a cost-benefit analysis of what they think they're going to get out of you by doing an audit. If you earn very little income, it's not going to be worth the auditor's time in order to actually do the research to look into what you're doing. This is why a lot of bands and things that do a lot of cash-only gigs might not have to pay any taxes on it, and they might get away with it because it's just not worth the IRS's time to actually look into it. Remember, the person auditing you is also getting paid for their time. So if it's costing the IRS more to audit you than they think they're going to get, then you're not going to get audited. But once you have been triggered, there's something fishy and they want to look more into it, there's two different ways that you're going to get audited. The first and by far most common is an audit by mail. This means that the IRS is going to send you a letter saying, hey, something's wrong with your taxes, we need additional documentation. So in this case, they might ask you for additional receipts, they might ask you for bank balances and things like that, just to verify the information that you've submitted with your taxes. This is by far the most common type of audit because it is just basically a lot cheaper for them to run. They just send out a notice, you send back the paperwork, and then they make a decision. For more extreme cases, they might want to do an in-person audit. This is a lot more common if you're a small business owner or if you have very complex income. Now, you as an individual have a far higher chance of getting audited by mail. And basically, it's the same decision for them whether they're going to audit you at all versus whether they're going to do it by mail or in person. Basically, if someone is coming to meet you in person or you're going to meet them in person, it means you're demanding a lot more of their time. You're going to have a lot more senior auditor working with you. So they're only going to do it if they really think it's going to be worth that auditor's time. If they audit you by mail, it just goes to a big office building full of clerks and auditors that can look at 100 cases per day. The most common reasons you're going to be audited by mail is things like stock returns, or if you have several different sources of income and you've also claimed a huge amount of expenses, like if you just bought a house but you've been working 3 jobs, or if you're a small business owner and you've just started launching a business and you're writing off a lot of your losses. And all they really want is they're going to send you a list of documents that they want to see, and you can also write a letter explaining how these are actually relating. With an in-person audit, they're going to ask you to come down to the office, or in extreme cases, they'll actually come down to your office. And in this case, it's because it's an extremely complex auditing process. And by that, I mean, it's not something that they're going to be able to hammer out just by you sending in some documents and taking a look at the letter that you sent. They want to go through some things line by line with you and get your direct explanation of why they are the way they are. If you get audited in person, you have a much higher chance of having to pay at least something, because they're not just asking for some simple verification, they're really digging into what you're doing. Keep in mind that if you do get audited, you will be notified by mail. They will not call you, they will not email you, it will be a letter that you receive. If you get an email, or if you get a phone call of someone saying they're from the IRS or getting audited, you can safely ignore it. The IRS doesn't do that, scammers do. The last thing to keep in mind, if you get audited and it turns out you do actually owe more money, you're going to have to make that payment pretty soon because you will have earned interest on it going back to when the tax was originally due. So the IRS does charge you interest on any late payments, so you're going to have to get a payment plan right away to get this audit paid off. So Best of luck to you. I hope you never get audited, but if you do, know what to expect.